financing. There are two ways to account for the extent of such leverage. The first is from the income statement. We can simply base our earnings power estimate on post-interest, pre-tax earnings. This approach assumes that the burden of leverage is constant over an indefinite future. But debt levels, especially increasing debt levels, are a matter of financial policy that may be changed relatively quickly at the discretion of management, and interest rates will fluctuate. When interest rates are unusually low, current pre-tax earnings will be at levels that are not sustainable when interest rates rise. The same problem in its inverse applies when interest rates are unusually high. They are likely to come down, and pre-tax margins will increase. A firm's underlying business, by contrast, is usually more stable and changes only slowly over time. If it does not have these characteristics, it is going to be difficult to value the firm at all. Operating income, therefore, is a better place to begin thinking about sustainable earnings power than pre-tax income, even when interest is a significant expense. Table 5.1. A second way of dealing with leverage is to look at the level of net debt rather than current interest payments. We can calculate an enterprise earnings value for a firm's operating business, ignoring net interest payments, and then adjust that value to get an equity value by subtracting the estimated value of net debt. As a first estimate, we can use the latest book values of debt minus cash and marketable securities. If necessary, these figures can be adjusted to approximate market value by looking at current market prices of the firm's debt securities, both owned and owed. We prefer the net debt approach because the balance sheet levels of debt, cash, and marketable securities are measurable with considerable accuracy, whether based on book values or market prices. On the cash and security side of the equation, a company's accounts should generally already have marked the book values of cash and investments to best estimates of the market value. EPV is the value of the company's operating business. The sum of this value goes to holders of the debt, leaving less for the owners of the equity. To calculate the EPV for the equity holders, we must subtract this amount, which should in theory be the value of the outstanding debt. At the same time, the portion of the cash and financial investments that are not required to support the basic operations of a firm represent value to the equity owners above the basic earnings power value of the company. Conventionally, all the cash and financial investments are assumed to be extraneous to operations. In practice, a firm needs some of these assets, perhaps 0.25 to 0.5% of revenues, for its smooth functioning. These amounts should be subtracted from overall cash and investments before adding them to the EPV of the company. Thus, there is no compelling need to add the errors inherent in projecting future interest rates to the calculated earnings power. A second major difference between operating earnings and pre-tax income is the earnings of unconsolidated subsidiaries, joint ventures, and minority interest in consolidated operations. As in the case of debt, these items appear on both the firm's balance sheet and its income statement. If they are peripheral to a firm's principal business, as often happens, there is a strong case to be made for handling these factors as adjustments to operating income. These assets and liabilities rarely trade in public markets. Private market values are often difficult to obtain unless full details for the relevant operations are included in footnotes to a firm's financial statements. Book values are based on original equity investments, adjusted for historical gains and losses that may bear little relationship to current economic values. For example, an unconsolidated venture may be near the end of the period of losses incurred in building the business, but may have significant current profitability. Actual value will be more accurately reflected in current profitability. If there is a significant discrepancy between the value of unconsolidated operations based on current earnings power and the values recorded on the balance sheet, then operating income should include these items before calculating average sustainable distributable income. If there is no such obvious discrepancy, then balance sheet adjustments, similar to those used in accounting for debt, can be used. In either case, the basic starting point for estimating earnings power will be operating margins and operating earnings. Taxes are real and inevitable reductions of earnings power, and operating earnings must be adjusted to take them into account. Again, operating earnings are the best place to begin. Average sustainable operating income, properly calculated, reflects the underlying economics of a company's business. For firms that can be reliably valued, this figure must be fairly stable, even taking into account average cyclical fluctuations. Taxes depend on government tax policies that are subject to periodic change. Average operating margins, including at least one or ideally two business cycles, may be calculated over a period of 7 to 15 years. Current average tax rates are likely to be stable over no more than 5 years. There is an obvious mismatch between the two time periods. The purpose of this entire exercise is to calculate the average distributable, meaning after tax, earnings as the firm sits there today. If there has been a major recent tax law change, then average tax rates since that change will be the relevant ones. It is common to make a distinction between cash taxes actually paid and tax liabilities calculated for income accounting purposes. For NPV calculations, the annual cash flow impact of taxes actually paid is the proper measure of the tax burden. But earnings power calculations are designed to capture average tax levels assuming no growth. Since long-term discrepancies between cash taxes and accrued taxes depend largely on growing tax credits, the no-growth assumption argues for using accrued taxes. In the long run, these accrued taxes must be paid. They are therefore the proper adjustment to earnings power. We can now lay out the steps in a basic earnings power calculation before accounting and other adjustments. 1. Calculate an average operating margin over an appropriate period. 2. Multiply this margin by current sales, or an estimate of average sustainable current sales. The product is an estimate of operating earnings, EBIT. 3. Adjust this estimate for the impact of the earnings of unconsolidated operations. 4. Calculate after-tax operating income by multiplying the pre-tax figure by 1 minus an appropriate average tax rate. Adjusted EBIT times open bracket 1 minus average tax rate, closed bracket. 5. The result is an estimate of sustainable distributable net operating profit after taxes, NOPAT. Adjusting for non-cash costs, depreciation, and amortization. Depreciation is the most significant area where there may be major differences between accounting measurements of non-current costs, the gradual wearing out of capital equipment, and economic reality. Accounting depreciation is calculated by spreading the historical acquisition costs of capital investments over an estimated useful life of each of the various types of investments involved. In the estimation of earnings power, actual depreciation is the cost of restoring the condition of the company's fixed capital at the end of the year to its state at the beginning of the year. It is the capital expense required to replace the lost capability of the firm's capital stock over the course of the year, or replacement CapEx, capital expenditures. Since replacement occurs in the present, the appropriate measure is the current cost of capital equipment, plants, and structures rather than some arbitrary portion of the historical cost. There are two obvious differences between these accounting depreciation figures and replacement CapEx requirements. First, if there are trends in capital goods prices, current costs will differ substantially from historical costs. Inflation-driven trends of increasing costs, in railroad construction, for example, will cause replacement prices to exceed historical ones, and accounting depreciation will understate true depreciation. Technologically driven cost reductions, as in information technology equipment, especially when improved machine performance is taken into account, will lead to replacement costs below historical costs, and accounting depreciation will overstate them. In either case, direct estimates of replacement capital expense should be used in place of accounting depreciation. A useful method of estimating replacement CapEx is to start with overall capital expense and then subtract an estimate of the capital expense devoted to supporting growth. Estimation of growth CapEx can be done in at least two ways. One way to segregate the two is to look for the periods of little or no growth in the history of the company, or of comparable competitors. During this time, total capital expenditures reported on the cash flow statement should consist almost entirely of replacement capital costs, since growth-related capital costs should be negligible. Any discrepancy between total capital expenditures and accounting depreciation should capture the necessary adjustment that needs to be made to actual earnings. A second approach is to estimate growth capital costs by multiplying growth in sales by an estimate of the firm's capital intensity, which is the ratio of fixed capital to sales calculated over an appropriately recent historical period. For example, if each dollar of sales appears to require 30 cents of capital investment, then a year in which sales grow by $80 million should require roughly $24 million in growth-related capital expenditures. This growth, CapEx, can then be subtracted from total CapEx to obtain an estimate of what is being spent purely to restore the fixed assets to their level at the start of the year. This estimate can be used in place of accounting depreciation as a more accurate figure of actual replacement capital costs. Some companies, such as railroads, will report their own estimates of replacement directly. Others report the details of their capital expenditures that can then be roughly divided into growth and replacement amounts. Detailed industry knowledge may enable an analyst to make these adjustments with remarkable accuracy, even if only aggregate investment and facilities growth numbers are known. Those who make a diligent effort to improve on reported accounting depreciation in the calculation of earnings power will have an advantage over those who simply rely on the official financial statements. One shortcut should always be avoided. Analysts will often use earnings before interest, taxes, depreciation, and amortization, EBITDA, in their measure of the company's basic earnings power. The unstated assumption is that replacement costs for both tangible, depreciation, and intangible, amortization, capital are zero. This is hardly ever the case. Buildings and other structures will often have accounting lives that are far shorter than their real economic lives. Their replacement values may actually increase rather than decrease over time. Adjustments to accounting depreciation of these assets must certainly be made. However, even buildings eventually wear out, and like equipment, they must be replaced. Assuming zero depreciation is inappropriate, even in these instances. The same is true for amortization. A product portfolio, customer base, or a trained labor force will deteriorate over time and need to be replenished. In the case of intangibles, however, the necessary replacement expenses may in fact be included in overall operating costs. Under these circumstances, including amortization as a cost will involve double counting, and adding back amortization to EBIT will be appropriate. In general, however, there is always a danger that relying on EBITDA will overstate earnings and lead to overvaluation and therefore overpayment for securities. A carefully calculated earnings power with proper adjustments to depreciation, expensed investments, and other accounting distortions will be a far superior measure of sustainable distributable earnings. EPV and estimating the cost of capital. The final step in computing a company's earnings power value is to divide its estimated earnings power by another estimate, this one of its cost of capital. This process converts the flow of earnings power into a level of value. Ultimately, we want to know what a firm is worth based on an estimate of reliably identifiable future earnings for comparison to the market price we must pay. Value is what an intelligent, well-informed investor is willing to pay for the firm at that level of sustainable earnings. Suppose the firm generates $25 million as a constant average annual future level of after-tax distributable earnings. The amount an investor would be willing to pay depends on the return he or she requires in order to voluntarily commit funds to acquiring the firm. If this figure is 10%, the investor will pay $250 million. $25 million represents an annual return of 10% on a $250 million investment. If the investor requires 12.5%, he or she will pay only $200 million, since $25 million represents a 12.5% return on $200 million. At an 8% required return, the firm will be worth $312.5 million, since the $25 million is 8% of $312.5 million. In each case, we obtain what the investor is willing to pay by dividing the earnings power by the investor's required return. Thus, the earnings-based value of the firm is EPV equals EP divided by required return. This required return is just the definition of a firm's cost of capital, the returns it must pay to attract investment voluntarily. The lower the required rate of return, the higher the value of the company. Estimation of the cost of capital, therefore, means understanding how investors determine their required returns and how these individual required returns translate into an appropriate required return for the firm. If we were asking about the average cost of labor per hour, there would be no mystery about how to proceed. We would identify the different types of labor to be hired, from highly skilled professionals to unskilled workers. We would estimate the fraction of the labor force in each category and the level of wages necessary to attract sufficient employees in each group. In competitive labor markets, we would look at what other firms are offering for similar jobs. Average wages would be calculated by multiplying the required wages for each class of workers by the fraction of such workers in our labor force and summing to get the total. We use an equivalent procedure to estimate the weighted average cost of capital. Firms basically employ two types of capital, debt and equity. The first step is to decide on the appropriate mix of debt and equity used in financing a firm's operations. Looking at the historical financial structure will be the best way to begin, just as we would look at the historical mix of labor types employed to estimate our hiring mix. However, there is one important difference when we consider the cost of capital. Debt financing imposes fixed payment requirements on a company that equity financing does not. Consider a firm that relies heavily on debt. As a rule, after-tax interest costs per dollar of financing are lower than equity costs, if only because interest payments are tax-deductible for firms. A highly leveraged firm, one with a high fraction of debt financing, will have a low calculated average cost of capital. However, this debt imposes a hidden cost. In times of economic stress, high debt, because of its payout obligations, may significantly impair the efficiency of a firm's operations. In a worst case, it will force the firm into bankruptcy. These distress costs are hard to quantify, but still need to be taken into account in calculating the cost of capital. They are not part of the cost of equity because equity financing does not interfere with company operations. Using a weighted average observed cost of debt and equity may grossly understate the true cost of capital for a company with excessive leverage. One way to handle this problem is to use a weighted average based on historical levels of debt and equity, but to set the weight of the debt at a conservative level below which it is unlikely to significantly impair a company's operations. For example, suppose that a company's recent debt level has been 70% of overall financing, but the upper limit of a safe level of debt is about 30%. Above that level, there is a significant probability of operational impairment. In that case, we would use 30%, not 70%, as the weight of debt in calculating the cost of capital. Graham and Dodd solved this problem by not investing in companies with high leverage, but we want to add a level of precision and open up opportunities. The way to estimate the cost of debt is analogous to estimating the cost of labor. Look at the yields available on publicly traded debt with comparable risk characteristics to the debt of our company. If that debt trades at yields of 5%, then our company will have to pay 5% to attract debt funding. This is the pre-tax cost of debt. If interest on debt is subtracted from profits before paying corporate income tax, then the net after-tax cost of the debt will be reduced by the tax saved. If corporate tax rates average 30%, that makes the after-tax cost of the company not 5% but 3.5%, thanks to a corporate tax saving of 1.5%, 30% of 5%, on debt financing. It is in this adjustment to the cost of capital that we account for any tax savings associated with debt financing. That is why we apply the corporate tax rate to all of operating earnings in calculating NOPAT. The cost of equity is more difficult to estimate than the cost of debt. Debt instruments provide well-defined returns whose yields, in the absence of default, are easy to calculate. Stocks produce both dividends, which may vary due to business conditions and are at the discretion of management, and capital gains, which depend not only on the performance of the company, but on overall financial market circumstances. For equity investments, we cannot simply identify comparably risky stocks and look at a stated yield on an investment in those stocks. Despite these hurdles, it is possible to make sensible estimates of the cost of equity capital. We begin by recognizing that because debt receives a contractual payment schedule and has a prior claim on a company's assets and earnings, debt investments are inherently less risky than equity investments. Thus, if investment-grade, at least BAA-rated bonds, with low probabilities of default yield, returns of 5%, a reasonable lower bound on the cost of attracting higher-risk equity financing is going to be 6%. At the other end of the risk spectrum, venture capital is widely regarded as the riskiest form of equity investment. It involves buying the shares of promising companies without either established economic positions or documented operating histories. A high proportion of these investments fail. Venture capital firms that make such investments regularly provide two kinds of information on the returns they must offer to attract capital. They report the levels of returns on their past funds, and they respond to industry surveys asking directly for the level of expected returns necessary to market their latest venture funds. Not surprisingly, these figures tend to cluster together. Historically, these venture costs of capital have been as high as 18 to 20%. More recently, they have been in the range of 13 to 14%. as overall investment returns have fallen with interest rates. Required equity returns for established firms without dangerous levels of leverage should be below this venture capital level at around 13% or less. Thus, the cost of equity capital in 2020 is likely to fall in a range between roughly 6% and 13%. If we are able to make qualitative judgments of the risks associated with investments in different firms, we may make our estimate more precise. We can divide company equities into low risk, e.g., utilities and stable consumer non-durable companies such as Coca-Cola, moderate risk, e.g., general non-financial service businesses such as United Parcel, and high risk, e.g., cyclical industrial and commodity companies such as Freeport, McMoran. Low-risk equities typically have cost of capital of 6 to 8%, or roughly 7%. Moderate risk equities need to offer 8 to 10%, or about 9%, and high-risk companies would face a cost of equity capital of 11 to 13%, an average of about 12%. By deciding into which risk category a particular company should be assigned, we can narrow the overall 6% to 13% range for establishing its cost of equity. As an example, we have a company in the moderate risk category that is financed with 20% debt and 80% equity. The debt has a pre-tax cost of 4.5%, which translates into 3% after taxes. The equity costs 9%. Putting the two together, we have a calculated cost of capital of 7.8%, Table 5.2. In practice, this level of precision in estimating the overall cost of capital is unrealistic. We should use 8% for computing our earnings power value, unless we had grossly misjudged the company's perceived risk and therefore its cost of attracting capital. We are not likely to be off in this estimate by more than around 1% or so in either direction, close enough for financial work. An alternative approach to estimating the cost of equity financing is provided by modern portfolio theory, MPT. One of the tenets of that theory is that the relevant measure of risk for any security is the incremental variability that it adds to a fully diversified portfolio, which is defined as the whole relevant market. The more variability the stock adds to the portfolio, which is designated beta in MPT, the riskier the investment, at least as risk is defined here. The market itself has, by definition, a beta of 1. A 1% change in the market equals a 1% change in the market. If a stock rises or falls by only 0.5% for each 1% move in the overall portfolio, adding more of that stock will lower the overall variability of the portfolio. This is the sense in which a stock like this, which has a beta of 0.5, represents a low-risk investment. In contrast, if a second stock rises or falls by 1.5% for each 1% move in the market portfolio, adding that stock to the market portfolio will increase the overall market variability. This second stock, which has a beta of 1.5, is a high-risk investment. The higher the beta, the riskier the stock. According to MPT, investors should require higher rates of return from stocks with higher betas, which are riskier by this definition. The amount of that required return can be calculated by looking at the average historical difference between the return on the market portfolio, with its beta of 1, and the return on a risk-free asset, usually assumed to be the short-term debt of a stable government securities, such as 3-month Treasury bills. Estimates of this extra return, the market risk premium, per 1 unit of beta risk run from 3 to 7%, depending on the relevant estimation period used. Another estimate of the overall cost of capital for the equity of a company with an arbitrary beta is the risk-free rate plus the risk premium per unit of beta multiplied by the estimated beta of the company's equity. Cost of equity capital equals risk-free rate plus beta times market risk premium. Betas are estimated from the slope of the historical plots of returns on the equity security in question against contemporary market returns on either a daily, weekly, or monthly basis. The beta of an average stock is 1. Errors in estimating betas are on the order of plus or minus 1/2. Thus, the beta-based estimate of the cost of capital for a moderate risk stock at a time when the risk-free return is about 1% runs from 2.5%, 1% plus a risk premium of 3% times a beta of 0.5, to 11.5%, 1% plus a risk premium of 7% times a beta of 1.5. In practice, for all the elegance of the theory, this range of estimated values is far too wide to be useful. The simple qualitative process described before will usually do far better. Earnings power value, equity value, and enterprise value. Once we have estimated an earnings power, including appropriate corrections for accounting depreciation and other adjustments, and a cost of capital, we can calculate the earnings power value EPV. This is an earnings-based valuation of a company's basic operations, as described in its financial statements. However, there is a final set of adjustments that must be made before the EPV can properly be compared to a company's asset value and its market price. Some of these adjustments relate to earnings. As we have noted, there may be peripheral, unconsolidated operations that are not included in operating income. Other adjustments are found on the balance sheet. There are valuable, non-operating assets that could be disposed of without impairing operations, such as excess cash, marketable securities, and non-core real property holdings. On the liability side, there are obligations that a company has incurred that may exist independently of its operating business and that do not involve explicit interest payments. Such legacy liabilities include unfunded pension obligations, unfunded retiree medical benefits, litigation cost overhangs, environmental remediation responsibilities, and similar balance sheet entries. There are a few key distinctions we need to keep in mind as we proceed. Between earnings power value and asset value, between the enterprise as a whole and the equity portion of it, between intrinsic value and market price. This last distinction is at the core of value investing, but it needs increased attention here because the term enterprise value can be used to refer to both an intrinsic value and a market price. We will start with the distinction between an equity approach and an enterprise value approach. Table 5.3 summarizes the key points of difference, which we discuss in more detail later. The earnings power value, the earnings power divided by a company's cost of capital, represents the value of the company's ongoing core operations. It differs from the value of the company's equity in two important ways. First, the company will often own assets that have significant value but are not required for sustaining ongoing operations. The value of these extraneous assets must be added to the core enterprise value in order to arrive at the equity value of a company. Just like the earnings of the enterprise, these assets belong to the firm's shareholders. Second, there are claims on the firm's operations and assets that must be paid before the shareholders receive their due. Outstanding debt is the most obvious of these obligations, but there are other debt-like liabilities that are not intrinsic to the firm's operations, which also must be satisfied. These include those pension obligations and other legacy liabilities, such as environmental charges and other legal settlements. The total of these claims, which we will refer to simply as debt, must be subtracted from the sum of core earnings power value plus extraneous assets to arrive at the value of the shareholder's stake in the company. Spontaneous liabilities such as accounts payable and accrued taxes arise in the normal course of business operations and need not be repaid on average, as long as a business sustains its current level of operations, and they do not usually require explicit interest payments. These spontaneous liabilities should not therefore be subtracted from the enterprise value in arriving at an equity value. To recap, the core earnings power value, EP divided by cost of capital, is an enterprise value. The value of a firm's equity is this enterprise value plus the value of extraneous assets minus debt obligations, broadly defined but not including spontaneous liabilities. By contrast, net asset values, which are calculated by adjustments to the book value of a firm's equity, are equity values from the start. Extraneous assets have been included, and the accountant's estimate of debt obligations has been subtracted to arrive at net worth, which is shareholder equity. Since we are primarily looking at equity investments in this book, it is natural to think of a margin of safety as the difference between the estimated value of a firm's equity, triangulating between earnings power and asset values, and the firm's market capitalization, which is the cost of buying the company's outstanding stock at its current market price. But we could equally well look at a margin of safety in buying the firm's ongoing enterprise. The value of that enterprise is measured by its earnings power value, sustainable earnings divided by cost of capital, on the one hand, and the net asset value associated with the core enterprise on the other. In this case, we must make adjustments to the traditionally calculated asset value of the equity. First, we must subtract the value of extraneous assets, since they do not support core operations. Second, we must add back the value of the debt liabilities, since we are calculating the firm's full enterprise value, not just the part of that value that accrues to stockholders. As with the equity valuation, spontaneous liabilities should not be added back, since they are intrinsic to the enterprise and do not require payments out of enterprise earnings. With these adjustments, we can triangulate between the earning power value and the asset value of the ongoing core enterprise to arrive at an intrinsic enterprise value. The margin of safety in buying this core enterprise is the difference between its intrinsic value and what we would have to pay to acquire it in the financial marketplace, including the debt and deducting what we could get from selling off assets extraneous to the core operating business. The result of subtracting the value of the extraneous assets from a firm's market cap and then adding the value of the outstanding debt is usually referred to as the firm's enterprise market value. This figure can be subtracted from our estimated enterprise intrinsic value to arrive at the margin of safety that applies to purchasing a firm's core ongoing operations. We can consider investments as either equity or enterprise purchases, provided we are careful to compare equity values to equity market caps and intrinsic enterprise values to market enterprise values, market cap minus extraneous assets plus debt. Even though the simplest way to proceed is to look at equity investments in terms of equity values, there is at least two advantages to taking an enterprise value approach. When we come to address the question of growth, we emphasize that growth rates typically apply to a company's core operating businesses. Non-core assets, legacy liabilities, and debt are driven by very different factors for which business growth is likely to carry limited weight. In assessing the contribution of growth to value, it clarifies matters considerably to focus on the enterprise and not overall values. In addition, Where a company is highly leveraged, the extent to which its equity appears to be a bargain may be dangerously misleading. Suppose we estimate a company's basic EPV to be $800 million. Assume it has $50 million in cash and securities and debt of $700 million, or $650 million of net debt. The total equity value of the firm will be $800 million minus $650 million equals $150 million. If the market value of the firm's common stock is $75 million, it looks as if we have found a bargain with a large margin of safety. We can buy the firm for 50% of its equity value. However, if the accuracy of our estimated enterprise value, EPV and AV combined, is plus or minus 15%, which is in practice a high level of precision, then the enterprise value may easily be as low as $680 million, $800 million minus $120 million. At this level, the value of the equity will be only $30 million, $680 million minus net debt of $650 million, well below the $75 million market price of the equity. In enterprise terms, we are paying $725 million, $75 million for the stock, $700 million for the debt, less the $50 million in cash we collect, for a company operations with a value of $800 million, which leaves a margin of safety of less than 10%. Since value miscalculations are related to the size and uncertainty of the enterprise value, the enterprise margin of safety is usually a more appropriate basis for investment decisions than the equity margin of safety. One last point should be stressed. Valuations may readily be calculated on either an enterprise or an equity basis. Assets' values are naturally calculated on an equity basis, but can easily be adjusted by adding debt and legacy liabilities and subtracting cash, securities, and non-core assets to obtain an enterprise value. In contrast, earnings power values are fundamentally calculated on an enterprise basis, but can easily be adjusted to obtain equity valuations by deducting interest payments. In either case, there must be consistency. Equity asset values must be compared to equity earnings power values and the costs of acquiring a firm's equity. Enterprise earnings power values must be compared to enterprise asset values and enterprise acquisition costs. This admonition is obvious, but even seasoned investors have been confused or ignored it altogether. Example 2. Magna International. Warren Buffett's classic advice, to be fearful when others are greedy and greedy when others are fearful, applied with special force in March 2009. Following the Lehman Brothers bankruptcy on September 15, 2008, global equity markets collapsed. Driven by fears of the second Great Depression, the S&P 500 index fell from 1,400 in May 2008 to 683 on March 6, 2009. A bottom appeared to be nowhere in sight, although that 683 print turned out to be the nadir. An environment so redolent of fear has historically presented extraordinary opportunities to produce stellar returns by buying companies at very low prices. And taking maximum advantage of these opportunities means looking at the most damaged parts of the stock market for companies that are unlikely to go bankrupt or suffer severe impairment to their operations. In early March 2009, those financial institutions that survived, often with government help, represented the scariest part of the stock market. But their safety and potential for survival was very difficult to assess. The second scariest part of the market was the automobile industry. In January, Chrysler had announced a potentially life-saving alliance with Italy's Fiat. But without major government support, the deal could not be done. And without the deal, Chrysler would have been forced to declare bankruptcy. On February 26, 2009, General Motors announced that it had lost $30.9 billion in 2008. Its cash reserves were down to $14 billion. And without substantial government assistance, it too would be forced into bankruptcy. And these were not idle threats. On April 30th, Chrysler filed for bankruptcy. In June, General Motors followed suit. Independent parts suppliers to the major auto manufacturers were in even worse shape. Delphi, the leading parts supplier that had been spun out of GM in 1999, had filed for bankruptcy in 2005. In May 2008, it had tried and failed to put together a plan to emerge from Chapter 11. Visteon, spun out of Ford in 2000, was delisted from the New York Stock Exchange in March 2009, as its stock price had fallen from 7 cents to 2 cents. Visteon's UK subsidiary subsequently filed for bankruptcy on March 31, 2009, and Visteon itself followed on May 28th. Lear Corporation, a major producer of automotive interiors and electrical systems since 1917, sought to save itself by spinning off its money-losing interior systems division in 2009. Lear had to pay the buyer to take it, but it was still near bankruptcy in March 2009. Ultimately, it filed for Chapter 11 protections in July. The imminent failure of their major customers, Chrysler, GM, and perhaps even Ford, threatened to deal a final death blow to the already weak parts supplier, who would be forced to write down the value of their accounts receivable and see their future business evaporate. To make things even chancier, many of these suppliers operated with large debt loads that heightened their vulnerability. Magna International, the one parts supplier unburdened by leverage, had other concerns. Incorporated in Canada, it was controlled via a dual share class by its controversial founder, Frank Stronach. Stronach held the majority of Magna's B shares, each of which had 500 votes, compared to 1 vote each for the A shares. As a result, even though he owned only about 20% of the economic interest in Magna, Stronach had absolute control of the board selection process, and hence, the company itself. He exercised this control without restraint. In 2008, he was paid a relatively small salary from the company, but a consulting firm of which Stronach was the sole employee had a long-term contract providing management services to Magna International. In the 13 years from 1996 through 2008, Stronach received more than $350 million from this arrangement, almost $30 million per year. That deal was not the only way that Stronach used his control of Magna International to enrich himself and support his personal interests. Passionately involved with thoroughbred horse racing, he was one of the largest racehorse owners in North America. In 1998, Magna, a car parts supplier, began to invest heavily in racetracks and auxiliary racetrack betting enterprises. These investments were organized into a separate subsidiary, Magna Entertainment Corporation, MEC. In 1999, MEC was spun off as a distinct entity listed on U.S. and Canadian stock exchanges, even though 90% of the stock remained in Magna International's hands. As a separate entity, MEC consisted of the horse racing properties, a greyhound track, 2 golf courses, and additional real estate to help ensure its economic viability. By December 31, 1999, Magna had invested $550 million in MEC. Profits were minimal. In 2000 and 2001, MEC had pre-tax earnings of $5.4 million and $2.4 million, respectively. In April 2002, MEC completed a secondary offering of 23 million shares, raising $142 million in additional capital. In 2002, the company had a pre-tax loss of $25.2 million, despite additional racetrack acquisitions for stock. At that point, Magna decided to place its residual 59% interest in MEC, together with its remaining portfolio of real estate, almost entirely leased to Magna International, into a new entity, MI Development, MID, which was spun off to stockholders on September 2, 2003. Shareholdings and share classes in MID mirrored those of Magna International, so that Stronach continued to have absolute control of the company. MID's subsequent history was as troubled as that of MEC. Its MEC subsidiary continued to suffer large losses. From 2003 to 2007, they totaled $412 million. These losses required substantial capital inflows in order to sustain MEC as an operating enterprise. From 2004 to 2008, contributions from MID came to $341 million. Despite the additional cash, MEC filed for bankruptcy on March 5, 2009. The shareholders of MID were dissatisfied with these practices, and MID was the subject of significant shareholder activism and lawsuits. Ultimately, in an effort to repair some of the reputational damage, MID changed its name to Granite Properties. Overall, Stronach's interest in horse racing may have cost Magna shareholders as much as $1 billion. A second troublesome Stronach intervention in the operations of Magna International was the installation of his daughter Belinda as CEO in February 2001. Belinda Stronach had attended 1 year of college and then left to begin working at Magna International. In 1988, at the age of 22, she became a director of the company. By 1997, she was a corporate vice president and head of its Divisia operating group. In 1998, she was promoted to executive vice president and within 3 years was CEO. She resigned from that position in January 2004 to pursue an interest in Canadian politics, where she had a brief but eye-catching career. She ran for the leadership of the Conservative Party against 2 experienced politicians, and having refused to join any of the public debates, finished a distant third. She later won election as a Conservative MP and then crossed the floor to the Liberal Party and provided the single vote margin that the Liberals needed to survive in a parliamentary vote of no confidence. As a Liberal, she received a junior ministerial position. But her controversial social relationship with a senior Liberal minister was a factor that contributed to the demise of the Liberal government. As a result of that and health issues, Belinda Stronach left politics. By 2007, she was back at Magna International as a senior executive in charge of special projects, for which she received $3.8 million as compensation in 2008. One last aspect of Magna's situation in March 2009 merits attention. In 2007, Stronach had entered into a joint venture with Oleg Deripaska, one of the more controversial Russian oligarchs, to produce automobiles in Russia. As part of his contribution to this venture, Deripaska purchased shares in Magna International at slightly below prevailing market prices. In the subsequent financial crisis, commodity prices dropped sharply, including the price of aluminum. Deripaska's fortune was based on his control of Russia's leading aluminum producer. His core enterprise under pressure, Deripaska was forced to sell his recently accumulated Magna shares. This added selling pressure helped contribute to a decline in Magna's share price from the peak of $97 per share in October 2007 to slightly under $20 per share at the beginning of March 2009. The Magna situation looked grim. It was operating in an industry under long-run economic pressure, with 2 of its major customers facing imminent bankruptcy. It was controlled by a manager with a checkered history of using the company as his personal piggy bank. The broader financial climate was dominated by fear and uncertainty. Magna's stock price had fallen by roughly 80%. By conventional measures, Magna was cheap. At $20 per share, the market value of Magna's equity was $2.24 billion, just 30% of its equity book value. The dividend yield was 6.3%. Although the P/E ratio for 2008 was 31.5 times, that was due to an unusually large temporary tax bill and depressed 2008 earnings. With a more normal tax rate of 33% and still depressed earnings at the 2007 level, the P/E ratio would have been 3.5 times. Magna International in early March 2009 was potentially an extremely appealing investment opportunity. However, given the many associated problems, which are what created the opportunity, an investor would need to do a painstakingly careful analysis before committing any funds. The first step in that analysis was to determine the extent to which Magna was subject to the risk of bankruptcy, the ultimate permanent impairment of equity capital. The December 31, 2008 balance sheet for Magna is presented in Table Example 2.1. It shows $2,757 million in cash, $194 million in long-term financial assets, auction rate notes with little default risk that had to be reclassified as long-term only because the auction market rate selling mechanism was temporarily impaired, and $1,209 million in debt. Most other auto parts suppliers were highly leveraged. Magna had $1,742 million in net cash at the end of 2008. And cash flow from operations minus investment was $315 million, $1,054 million less, $739 million in investment. In prior recession years, cash flow from operations had been only slightly negative, as decreases in investment to less than depreciation and amortization and reductions in working capital offset net losses. Unless conditions in the auto industry deteriorated severely for a very long time, Magna International was not going bankrupt. The next question was the long-run future of North America and European auto industries. Roughly half of Magna's business was in Europe, and of independent parts suppliers such as Magna. In the long run, it appeared highly unlikely that either the industry or the independent parts suppliers were going to disappear. In 1967, McKinsey had provided a report to the newly established United States Urban Mass Transportation Administration on the future of U.S. transportation. McKinsey forecast that the future would involve independently guided vehicles operating on shared use rights of way. Translated from consultant speak, it predicted there would be cars, trucks, and buses operating on roads. As late as 2009, McKinsey had been proven right. Nothing about transportation technology in the intervening years seemed to indicate that the advantages of independently guided vehicles and shared use rights of way would vanish. North American and European automobile production was protected by another significant long-term trend. Automation in manufacturing was rapidly reducing the labor input required in car production, which in turn reduced the benefits of manufacturing in low-cost labor markets outside Europe and North America. Reductions in transportation costs were much less dramatic. Seaborne transportation already used very little labor, and the benefits of being close to end markets were, if anything, increasing. As a result, by the mid-2000s, high-end manufacturing production, such as automobiles, but not manufacturing employment, was returning to developed economies from the less developed ones. This trend was likely to continue. Finally, continued unionization and/or high wage levels at the big auto producers in Europe and North America meant that the cost advantages of independent parts manufacturers like a Magna were not going to erode. Having confidence that the immediate bankruptcy risk of Magna was low and its long-term economic future was not in serious jeopardy, an investor should be prepared to expend the effort to develop a detailed evaluation for Magna International. The way to begin that valuation was by looking at Magna's asset and earnings power values in early 2009. the value of growth was likely to be minimal. Magna's customers were large automobile manufacturers, General Motors, Ford, Daimler-Benz, BMW, with large professional purchasing departments, not about to let themselves be captive to any particular parts supplier. Economies of scale were also likely to be relatively insignificant. There were many companies like Magna, each of which had multiple manufacturing facilities. Dominant competitors in any auto parts market were rare. Without barriers to entry, the value of growth for Magna, as for any company without a sustainable competitive advantage, was likely to be minimal. Historical returns on equity confirm the reality of a competitive market. Asset value. In Chapter 4, we computed the reproduction value of assets of several fictitious firms on a line-by-line basis going down the asset side of the balance sheet. We then did the same for a company's liabilities. In those cases, which we constructed to be representative, the estimated reproduction value of many assets and liabilities differed only minimally from their book values. This applied to most liabilities and most current assets. In practice, therefore, it is usually more efficient to begin with the net book value of assets and then add or subtract amounts that reflect differences between the reproduction and book values only for those assets and liabilities for which these differences are significant. For Magna, the important differences are 1. Between the book value of goodwill and the reproduction values of the intangible assets giving rise to that goodwill, and 2. Between the book value and reproduction costs of fixed assets. The book value of equity for Magna at the end of 2008 was $7,336 million. The various elements of fixed assets are presented in Table Example 2.2. As we did in the case with Hudson General, for land and buildings we called local assessors in the area where Magna's properties were located. They estimated that on average, the properties had appreciated at least 25% in value since they were acquired. Acquisition dates are roughly available from historical annual reports. Adding 25% to original costs yields estimated reproduction values for land and buildings of $265 million and $1,070 million, respectively. Construction in progress represents assets in the process of reproduction, so that original and reproduction costs for them should be the same. Magna's machinery had an estimated average life of 8 years. For a stable company, neither growing nor shrinking, machinery in place should be on average halfway through its useful life. For growing companies, it will be less than halfway. For shrinking companies, more than halfway. Magna had been growing steadily, but we will make the conservative assumption that its machinery was halfway through its useful life and retained half of its original value. Next, we recognize that the cost of acquiring new automotive manufacturing equipment had been declining over time at about 4.7% per year. Machinery that was 4 years old, on average, should have been replaceable at 20% below its original cost, a decline of 4.7% per year compounded for 4 years. Dividing the $7,700 million first in half and then by 1.2 yields a reproduction value for machinery of $3,208 million. That brings the total estimated reproduction value of all of Magna's fixed assets to $4,856 million, $1,648 million for land, buildings, and CIP, and $3,208 million for machinery. This figure is $1,115 million above Magna's year-end fixed asset book value of $3,701 million. In computing overall reproduction value for Magna's net assets at the end of 2008 in Table Example 2.3, we begin by adding this $1,115 million to the equity book value of $7,363 million. The book value of intangibles on Magna's balance sheet at the end of 2008 was represented by the goodwill item of $1,160 million. But this figure was the result of following accounting rules to value Magna's many past acquisitions. It was not based on a careful consideration of Magna's actual intangible assets. To clean this up, we will subtract this artificial figure from Magna's book value and replace it with a detailed valuation of Magna's genuine intangible assets. Magna has significant value for its intangibles in three areas: its book of annual business, its product portfolio, and its trained labor force. For other companies, the value of an established organizational structure could be added to this list. But Magna had a highly decentralized organization that had arisen organically from its everyday activities. The expense associated with reproducing that organization was likely to be minimal. The sustainable size of Magna's customer base, its book of business, was about $24 billion. Revenue of $26 billion in 2007 represented a cyclical peak. The subsequent drop to $23.7 billion in 2008 was the beginnings of movement toward a cyclical trough. The measure of reproduction value per dollar of revenue is the cost of acquiring those customers in the most efficient way possible. One way is through an independent sales agency. These typically charged 5 to 10% of first-year sales as commission for obtaining sales contracts from customers like Magna's. If we use a midpoint estimate of 7.5% in fees per dollar of sales, then Magna's $24 billion book of business would have a reproduction cost of $1.8 billion, 7.5% of $24 billion. Magna's labor force of 75,000 in early 2009 was made up of very different kinds of workers. About one quarter were unionized. The net asset value of such workers to Magna, given their wage levels, was near zero. A second quarter were skilled technicians, engineers, and managers with average salaries of roughly $60,000. Human resource recruiting firms typically received about one-third of a year's salary for successfully providing these employees. At that rate, their reproduction cost value would have been roughly $20,000 each, one-third of $60,000. The remaining half of the trained labor force would have an acquisition cost/value about halfway between that of the unionized workers and the skilled professionals, or roughly $10,000 each. The overall reproduction cost/value of Magna's labor force was 75,000 times the average acquisition costs per worker of $10,000, or $750 million. Magna's product portfolio consisted of between 4,000 and 6,000 individual items manufactured for the major automobile companies. Some of the cost of developing and preparing to produce these items was specifically reimbursed by the big automakers. In 2008, the value of these reimbursements for 1 year's new products was $92 million. This appears to have represented about 1/5 of the full cost of product design, manufacturing, development, and tooling. A product portfolio roughly 5 years or less represented a Magna investment of about $2,250 million, 450 times 5. This comes to about $0.5 million for each of Magna's 5,000 or so products, excluding assembly operations, not an unreasonably high figure. Magna's intangibles had a total value of roughly $4.8 billion, $1.8 billion plus $750 million plus $2.25 billion, or $3.7 billion above book value. These calculations are set out in Table Example 2.3. The total figure of $3.7 billion of non-acquisition-related intangible assets represents about 3 years' worth of Magna's approximately $1.2 billion of SG&A. Given the size and complexity of the company's operations, this seems an appropriate level for the reproduction cost that an entrant would incur in order to reproduce these intangibles. The resulting net asset value on an equity basis for Magna in early 2009 was about $12.2 billion. The asset value of its ongoing operations was about $10.4 billion, with the remaining $1.7 billion representing net cash. Earnings power value. A 10-year operating history for Magna's automobile business is presented in Table Example 2.4. It includes 2 down cycle years for the industry, 2001 and 2008. In general, the period from 1999 through 2008 was a difficult one for the auto companies, especially in North America, where rising gas prices, starting in 2003, undermined sales of relatively high-margin SUVs and light trucks. Average sustainable revenues for Magna in 2008 were probably between the $26 billion of 2007 and the $23.7 billion of 2008. We used $24 billion in calculating the value of Magna's book of business, which allows for the effects of the recession once every 8 or so years. Sustainable operating margins are more difficult to estimate for 2 reasons. First, there was a steady downward trend in margins from 7.8% in 2000 to 4.1% in 2007, and then to 1% in the recession year of 2008. If we merely extrapolated this trend, we might estimate sustainable margins of between 2% and 0. Second, the whole period after 2003 was one of poor demand conditions for Magna and the automobile industry as a whole, reflecting a slow adaptation to rising energy prices. Simply taking the 10-year average operating margin of 5.4% may actually understate future margins as the industry adjusted to lower demand. At margins below 4%, it is not certain that returns on capital would be sufficient to attract the investment necessary to sustain the output of what we have already identified as an economically viable business. Returns on equity for Magna during this period, with operating margins below 4%, were consistently less than 10%, which would be an appropriate cost of capital in early 2009 for a cyclical industry such as autos and auto parts. We will use an initial sustainable operating margin estimate of 5%, and then look at the reasonableness of the resulting earnings power value. With a sustainable margin of 5% and revenues of $24 billion, sustainable operating earnings would be $1.2 billion, close to the operating earnings of 2007. An average tax rate of 33% lies between a U.S. rate, including state and local taxes, of 39% and lower rates in Europe, where half of Magna's operations were located, and Canada. Sustainable taxes of $0.4 billion leave net operating profit after taxes of $0.8 billion, which is our estimate of the earnings power of Magna's operations. The principal adjustment that must be made to this estimate involves depreciation. As we noted in computing Magna's asset value, accounting depreciation overstates actual depreciation for 2 reasons. First, for accounting purposes, building values are depreciated over time, typically at 2 to 3% of original cost per year. In practice, the value of these buildings, if properly maintained, actually increases. Thus, accounting depreciation overstates economic depreciation for these components of Magna's fixed assets. Second, the cost of automotive production machinery between 2000 and 2008 was declining relatively rapidly. Economic depreciation for this equipment would be the cost of replacing it and maintaining an unimpaired capital stock. Falling machinery prices would make replacements lower than the original cost of the machines on which accounting depreciation was based. In this area as well, accounting depreciation would overstate actual depreciation. The amount of excess depreciation can be roughly estimated by looking at the years 2007 and 2008. Over this period, Magna's revenues declined slightly, so that the fraction of capital expenditure to accommodate growth should have been minimal. If we assume that for these years all capital outlays were maintenance capital expense, Then true depreciation averaged $740 million, $739 million in 2008, and $741 million in 2007. See Table Example 2.4. The average accounting depreciation and amortization was about $873 million, $873 million in 2008, and $872 million in 2007. The difference of $133 million is a useful estimate of the excess accounting depreciation that must be added to accounting earnings to calculate actual earnings. In 2008, this extra $133 million in earnings was protected from taxation by the depreciation tax shield. It simply did not appear as part of taxable profits. However, as lower maintenance capital expense leads to lower subsequent depreciation, the tax shield will gradually disappear. Once the tax shield is gone, the excess depreciation part of profits will be fully taxed at the 33% rate. On average, this portion of profits would be taxed at almost 10% in present value terms. The average excess depreciation after tax was thus about $120 million, $133 million minus $13 million average tax. These adjustments bring the earnings power of Magna's core business to $920 million per year in early 2009, $800 million plus $120 million in excess depreciation. In early 2009, B-rated corporate bonds were trading at yields of roughly 7%. At the same time, returns required to attract investors to new venture capital funds were around 14%. Thus, the range of possible costs of capital for Magna lay between 7 and 14%. A relatively risky firm such as Magna, but without excess cash, would have an equity cost of capital equal to that of an average firm. Within the 7 to 14% range, the low-risk firm would have had an 8% cost of equity, an average risk firm would have had a 10% cost, and a high-risk firm would have had a cost of 12 to 13%. Thus, an appropriate cost of capital for Magna from early 2009 going forward would have been about 10%. The earnings power of Magna's core business at that time was $920 million, $800 million plus $120 million in excess depreciation. Capitalizing the $920 million in earnings power at this rate, 1 divided by 10%, or 10 times, yields an earnings power value for Magna's core operating enterprise of $9.2 billion. The earnings power value of Magna's equity includes this $9.2 billion plus $1.7 billion in net cash, a total of about $10.9 billion. Final valuation. The earnings power value, asset value, and market price for Magna International in March 2009 are summarized in Table Example 2.5. The first point about these numbers is that the asset and earnings power value estimates are essentially equal, within 12% of one another. In terms of 3 possibilities for comparisons between asset value and earnings power value, this is a case B, a firm without significant competitive advantages, but with a capable management. The lack of a clear competitive advantage for Magna is also apparent from the return on equity levels in Table Example 2.4. The 10-year average return on equity of 10.4% almost exactly equals our 10% estimated cost of equity capital for Magna. Qualitative considerations further argue against the existence of sustainable competitive advantages. First, as we noted, its customers were large auto companies with professional purchasing departments. They were unlikely to be captive to any individual supplier for very long. Second, Magna's technologies were well-known and seasoned. Proprietary techniques and patents did not play a significant role in its operations. Third, given the large number of decentralized manufacturing, marketing, and other operational facilities, it is unlikely that the economies of scale were significant. Without these barriers to entry associated with sustainable competitive advantages, growth for Magna would not create value. Thus, for valuation purposes, we need not concern ourselves with future growth rates in demand and/or cost-reducing technological change at the industry level. The fact that earnings power value is so close to asset value is somewhat surprising, given the historically questionable behavior of management. But it is greatly reassuring in two respects. First, the asset value of $12.2 billion assures that in the long run, the negative trends in margins could not continue. An earnings power value significantly below $12.2 billion would not provide a return on assets sufficient to elicit the investment necessary for the continued viability of the North American auto and auto parts industries. Since the qualitative economic factors that we considered at the beginning of our analysis of Magna argue strongly for their continuation, future operating margins must be at or near the 5% level that we assumed in calculating our earnings power value. The triangulation between asset and earnings power values strengthens confidence in our earnings projections, confidence that was necessary to make an investment in Magna in the face of the troubling circumstances surrounding the company in March 2009. Second, despite the difficult industry conditions facing Magna between 1999 and 2008, the company's management achieved operating margins, provided you believe the accounting numbers, that produced a cost of capital return on assets. This was accomplished despite the misuse of funds for racetrack investments and the consequences of nepotism in executive appointments. The contrast with Hudson General here is instructive. Hudson General's management destroyed substantial value, as was evident from the large gap between asset value and continuing earnings power value. No such gap is apparent for Magna International. Given these considerations, the margin of safety from the valuation analysis summarized in Table Example 2.5 is comforting. In equity terms, Magna, in March 2009, was selling at just 20% of its roughly $11.6 billion intrinsic value. In enterprise terms, after deducting the net cash of $1.74 billion from Magna's $2.24 billion market price, Magna's operating business was selling for about 5% of its $9.9 billion intrinsic value. Unless we have overlooked some important negative factors, Magna, as might be expected under the then prevailing economic and market circumstances, was a highly attractive investment. Potential issues. The final step in our investment analysis is to consider problems, like the continuation of management's depredations at Hudson General, that might undermine the profitability of an investment in March 2009 in Magna International. Three potential issues are worth examining in detail. They are: 1. The possibility that the auto industry was on a path of terminal collapse, perhaps along with the rest of the global economy. 2. The potential that the costs of mismanagement were not being fully taken into account. And 3. The chance that the accounting numbers on which we relied for our valuations were fraudulent. We consider each of these possibilities in turn. We addressed the issue of North American auto industry failure at the beginning of this analysis. Barring a global economic collapse, it was not going to happen. It is worth remembering that much of the world had begun to emerge from the Great Depression before the onset of World War II. Moreover, once the war ended, and contrary to the opinion of most contemporary economists, the Depression did not return. Modern industrial economies have proved to be very resilient. Since the end of World War II, the scope of active government support for private economic activity in times of stress has greatly increased, further reducing the already small chance of total economic meltdown. Complete economic collapse, and with it the complete collapse of the auto industry, does not seem to have been a realistic economic prospect facing Magna in early 2009. The potential damage from self-serving management behavior also appeared to be limited. First, It is important to remember that the operational and balance sheet numbers on which we base our analysis were recorded after taking account of management expropriations. Thus, only if management abuses were to increase after March 2009 would our calculated valuations be too optimistic. And the recent trend was in the opposite direction, toward a lower cost of management misbehavior. The racetrack folly was largely resolved with the spin-off of MID in 2003. More recent transactions with MEC involved golf, not horse racing, which was a much less costly undertaking. In 2006, Magna bought 2 golf courses in Ontario, Canada, and Austria from MEC for a total of $84 million, including assumed debt of $21 million. In 2007, Magna bought additional Austrian land for $29 million from MEC. Finally, in the first quarter of 2009, Magna arranged to purchase additional Austrian land from MEC for $5.7 million. The trend in the cost of Magna's interactions with MEC was clearly downward. The danger that significant company operations would come under the control of Belinda Stronach, which had never been high given the decentralized structure of divisional management, had essentially vanished by 2008. Payments to the Stronach family in salary and consulting fees seemed to be shrinking. Finally, the threat from any Deripaska joint venture had largely receded due to his financial difficulties. Overall, the cost of family control was diminishing. On the other hand, if Magna's accounting statements were fraudulent, our investment would be in genuine danger. Here, however, we were paradoxically protected by Frank Stronach's dodgy reputation. Magna's accounts in 2008 were audited by Ernst & Young, a Big Four accounting firm. In the wake of the Enron and WorldCom scandals in 2002 to 2003, which led to the demise of Arthur Andersen, large accounting firms were not likely to give the benefit of any auditing doubt to someone like Stronach. One reason that WorldCom and Enron were able to escape careful scrutiny was that they were regarded as leading-edge innovative firms run by visionary managements. In the event of an auditing dispute, a management with even a slightly questionable history was not likely to be able to manipulate a well-established auditor. The danger of accepting management accounting misrepresentation was more apt to come from firms such as Amazon, Tesla, Alibaba, Google, or Facebook than from Magna International. The credibility of Magna's profit numbers nevertheless deserves careful scrutiny. One way is to examine financial statements over an extended period of 5 years or more. Short-run accounting manipulations are far easier to sustain than long-run misstatements. From 2004 through 2008, Magna reported cumulative net earnings of $2,650 million. It also reported sales growth of $8,359 million. The profit figure might look inflated, but tampering with the sales growth numbers would be difficult. Magna's customers, who were the counterparties for its reported revenues, were large U.S. and European automobile manufacturers. In an audit, they would be contacted to verify reported sales, and they were unlikely to support any material revenue misrepresentations by Magna's management. Of the $2,650 million of reported profits, $686 million were distributed to shareholders as dividends and net stock buybacks. These payments leave a clear paper trail about which there is little definitional ambiguity. The $686 million of reported net distributions would have been almost impossible to fake. Next, from December 31, 2003 to December 31, 2008, Magna's audited balance sheets showed an increase in net cash of $512 million, from $1,230 million to $1,742 million. Outside of Italy before the Parmalat scandal, in which Parmalat claimed to have $5 billion invested in hedge funds that were non-existent, cash balances and debt obligations are essentially impossible to misrepresent. The transactions involved leave clear paper trails, and the auditor sends confirmation letters to the institutions holding the funds. Thus, of the total $2,650 million in reported profits over the 5 years, $1,198 million could reliably be accounted for by net cash accumulation and net distribution to shareholders. The remaining $1,452 million of earnings had to support revenue growth of $8,359 million, an investment of roughly 17 cents for each incremental dollar of sales. This is a very low level of net investment, especially compared to long-run levels of Magna and industry operating margins of 5 cents per dollar of revenue. If Magna were inflating its earnings by 10%, then true earnings would have been $265 million lower than the reported 5-year total of $2,650 million. As a result, true investment would have only been $1,187 million, $1,452 million minus $265 million. This would mean that Magna was investing only about 14 cents per incremental dollar of sales, a remarkably productive use of capital. The actual 10-year figure was 16 cents. Similar calculations for Enron in 2002 would have shown investment of more than $3 per $1 of incremental revenue. For WorldCom, the number would have been essentially infinite, since WorldCom was reporting huge implied investment levels while revenues were falling. Given the implied efficiencies of capital allocation implicit in Magna's numbers, it is very likely that Magna's reported long-run profits had been exaggerated. Indeed, it is clear that for all of Stronach's dubious behavior, Magna was a highly efficient capital allocator and operator. This is also evident from Magna's long-term record of solid growth and its ability to satisfy its demanding automobile manufacturing customers. The likelihood that Magna's reported results involved a significant degree of misrepresentation was very small. As a result, an investment in Magna International Equity at $20 per share around March 1, 2009, looked like an attractive opportunity. In contrast, a DCF valuation based on continuing projected declines in Magna's income would not have identified the asset protection that effectively ruled out such a scenario. Thus, investors approaching Magna from this non-Graham and Dodd perspective generally missed the opportunity. 10 years later, at the end of February 2019, the share price was $52 after a 4-for-1 split, an annual return on price appreciation of 26%. In retrospect, the Magna investment seems so obvious, given the asset protection and the deep margin of safety. But in retrospect, we are all geniuses. It takes courage to be greedy when others are fearful, and one path to courage is to have confidence that you are equipped with the analytical tools appropriate for the job. 6. Growth. Asset value and earnings power value are the first two components of a complete valuation description. We now look at the third element, growth. It has generally been taken as axiomatic that the value approach, with its preference for tangible assets and current earnings power, discourages its adherents from investing in high-technology companies and other growth stocks. Though there is some truth in this idea, especially as it applies to more traditional Graham and Dodd investors, it ignores some significant innovations in valuation that modern value investors have devised. Warren Buffett and a number of other prominent value investors favor the shares of good companies, by which they mean firms like Coca-Cola, companies that increase steadily in value over those that are merely cheap. In this context, a good company, sometimes elevated to a great company, is one that can pay out cash to its investors even as it funds its growth. Today, these companies, franchise businesses in Buffett's terms, constitute a large and growing fraction of the market value of publicly traded securities. At the same time, hard asset-based businesses are becoming less important. This trend toward franchise-based value is evident in the high profitability and sustained trillion-dollar valuations of companies such as Microsoft, Google, and Apple. It is also clear from the way in which Walmart and McDonald's have created hundreds of billions in market value for traditionally atomized service industries. Healthcare, now a major sector, was formerly represented in securities markets almost exclusively by the major pharmaceutical companies. Today, significant health investment opportunities include health insurers, prescription drug fulfillment companies, hospital chains, specialized treatment businesses, and a multitude of high-tech equipment and biotech opportunities. All of these non-pharma companies have franchise characteristics. At the same time, historically dominant franchises businesses, General Electric, IBM, General Motors, and whole industries such as newspapers have seen their values greatly diminished or even disappear. The ability to recognize franchises and to value growth accurately are essential and challenging skills required of modern Graham and Dodd investors. For value investors as a group, the main historical reason for avoiding these growth companies is that they are rarely favorably priced. They are often the kinds of lottery ticket, get-rich-quick stocks for which many investors repeatedly overpay. The evidence cited in Chapter 2 indicates that in almost all extended periods, in almost all countries, portfolios of growth stocks regularly underperform broad market indices. After years in which expectations drove prices beyond any reasonable estimate of underlying value, markets corrected. Some telling examples are Japanese stocks in the 1980s, technology and telecom stocks in the 1990s, and Chinese and other emerging market stocks more recently. By the time their prices declined and their valuations returned to earth, they had cost their enthusiastic shareholders substantial sums, as well as vaporizing their unrealistic expectations. Value investors of any stripe need to be keenly aware of this pattern. The historical success of value investing has been based in large measure on the ability of value investors to avoid being caught up in these manic episodes. Growth stocks, chosen selectively, are not forbidden fruit for value investors, as Buffett and others have demonstrated, but they must be bought with great care and the skillful application of an appropriate valuation process. The traditional Graham and Dodd approach to growth investing. Graham and Dodd recognized that the value of a franchise business is rooted in earnings power rather than assets. Being unwilling to pay extra for growth, they based stock purchase decisions on the margin of safety between the current earnings power value without growth and the market price of a company. Growth was treated as a qualitative factor that might justify a smaller margin of safety, but its calculated impact was never incorporated into quantitative valuations. In a world where investors have historically overpaid for growth stocks, this cautious approach has much to recommend it. Most forecasts of future growth rates of company revenues, earnings, and thus value are systematically biased. First, growth forecasts suffer from significant systematic biases. Short-term trend extrapolation is a staple of forecasting practice. Companies that have produced high recent growth rates are forecast to have high future growth rates. Companies that have shown low or even negative growth rates are expected to continue on that path. But the realized growth rates for the formerly high flyers generally disappoint, while the slow growers exceed expectations. These forecasting biases have been widely reported in the academic and professional literature. Yet most investment analysts persist in projecting the most recent past into the future. The traditional Graham and Dodd approach avoids these pitfalls by not relying on quantitative growth forecasts. Second, growth stocks will be overpriced when estimated values depend on the growth of companies whose supposed competitive advantages are hard to identify, or if they exist at all, are likely to be short-lived. In these cases, the allure of growth overwhelms the fact that only franchise growth creates sustainable value. For example, many companies in some emerging markets show rapid earnings growth, but most of them do not benefit from sustainable competitive advantages. In emerging economies, consumer tastes evolve quickly, an unstable preference that undermines customer captivity. Also, especially in Asia, emerging market countries have high population density. Thus, even in local service operations such as retail, new entrants can be viable at relatively low levels of market share. With fragile market share advantages and low customer captivity, competitive advantages, or moats, will be narrow and often insignificant. At the same time, there's usually a large roster of powerful companies in developed countries, hungry for the growth opportunities offered in emerging markets. Emerging market companies that are export-oriented may also expand rapidly, but they are necessarily competing in large global markets that are highly competitive. The ability of companies in emerging markets to transform rapid growth into value creation is likely to be far less than is often forecast. A similar reality affects markets for exciting new products and services, the emerging markets of product geography. The often touted first mover advantage, meaning entry into these markets in their early, rapid growth phases, does not usually lead to sustainable, long-term competitive advantage and high profitability. Rapidly changing technology is the enemy of customer captivity. Early adopters are constantly on the lookout for newer and better alternative products. Subsequent adopters who look at the range of products available are unattached and non-captive customers. During early rapid growth periods, most potential users are not yet customers. Their numbers are usually sufficiently large compared to existing users that in the race for economies of scale, later entrants are not materially disadvantaged. Finally, rapid technological change tends to undermine and hence minimize the advantages of proprietary technology. Firms that ultimately dominate these markets have generally been those that enter at a time when technology is stabilized and user numbers are a high enough proportion of the ultimate market to produce sustainable scale advantages, a development for which Google and the search engine market is a prime example. Judging whether this point has been reached and what ultimate value will look like is difficult even for expert industry observers. It is almost certainly beyond the capacity of most general investors. A third problem that besets growth investing is that growth stocks are usually priced at very high multiples of current earnings or cash flows. For example, in late 1999, Microsoft traded at 70 times any reasonable estimate of current sustainable earnings. At that time, Microsoft paid no dividends. Any direct cash returns to investors, as opposed to potential capital gains, were being deferred into the far distant future. Microsoft's earnings were growing at more than 25% per year, an attractive rate, but one that was clearly not going to last indefinitely. To establish a value for cash returns to investors, let us assume that Microsoft were to start distributing half its reported earnings to shareholders and could do so without impairing its growth rate. Assume further that the growth rate were to average 25% in the intermediate future, up to 10 years out, and investors were to discount future cash returns at a cost of capital of 10% per year, a relatively low rate for a then high-risk tech stock as Microsoft. Using these assumptions, the value of cash received over the 10-year period from 2000 through 2009 would be worth roughly 10 times Microsoft's current earnings. This discounted dividend payout would represent about 15% of Microsoft's then market price of 70 times earnings. The remaining 85% of the price paid for Microsoft in 1999 depended on payouts and performance in the years after 2009. For a company operating in a rapidly changing economic and technological environment as Microsoft in 1999, accurately anticipating events in 2009 and beyond was difficult if not impossible. Such a growth stock purchase in 1999 would have been, in Benjamin Graham's terms, a speculation, not an investment. Not surprisingly, it would not have worked out well. After the tech bubble burst in 2000, it took Microsoft stock 16 years to return to its price in 1999, although there were dividend distributions along the way. Similarly, expensive growth stocks are usually poor investments, meaning they have returned less than the market overall. Given upwardly biased growth rate forecasts, the limited duration of many competitive advantages, and the high prices at which growth stocks sell when compared to current earnings or cash flow, it is hard to disagree with the traditional Graham and Dodd aversion to paying explicitly for growth. Despite these difficulties, Warren Buffett, Charlie Munger, and several other modern value-oriented investors have earned consistently above-market returns by investing in growing franchise businesses. They have demonstrated that a disciplined value approach to investing in growth opportunities can be successful. A traditional value investor will sell when a company's market price reaches or exceeds its value. If the value is static, the investor sells when the price is recovered from what is often a temporary sell-off or setback. This recovery approach defines a fixed horizon for earning a decent return. But if the value of the company increases continuously, it may be many years before a company's value and market price converge. A longer holding period means lower trading frequencies, lower transaction costs, and deferral of capital gains taxes for many years. As a consequence, while investing intelligently in growth stocks is difficult, it is an essential and worthwhile extension of the traditional Graham and Dodd approach to investing. An investment based on a firm's prospects for growth must satisfy two requirements. First, the growth must create value, which is no sure thing. For many companies, or more precisely for the shareholders of most companies, the growth is at best a break-even proposition. As we noted briefly in Chapter 4, this sobering news applies equally to high-tech firms that expand by selling more superbly engineered tools or aesthetically elegant gadgets, to online retailers who multiply their offerings, and to restaurant franchisors that expand by opening more outlets. Growth creates value only when the investments required to support the growth earn more than the cost of capital. In the distinction we made in Chapter 3, in Figure 3.2, it is only Case C, where earnings power value significantly exceeds assets values, that growth will produce net distributable cash after investment to existing investors. Second, not all growth, even growth that is worth something, can be appraised with enough precision to permit an accurate valuation. Because value investors demand a margin of safety, they will buy growth only at a substantial discount from its estimated value, a discount large enough to make up for the greater uncertainty in valuation. The ideal price for growth is zero. Pay in full for the current assets or earnings power and get the growth for free. Despite these warnings, there are circumstances under which even disciplined value investors may pay something for growth and be rewarded provided they keep these two requirements squarely in view. 1, that the growth will in fact create value. 2, that there is a measurable margin of safety included in the price paid for it. Though the first rule is uncomplicated, it is not well understood by most investors. The second calls for a major readjustment in the Graham and Dodd approach to valuation. We will discuss the two requirements one at a time. In this chapter, we will identify the circumstances under which growth genuinely creates value, as distinguished from those in which either growth contributes nothing and can therefore be ignored in the investment decision, or those in which growth actually destroys value and investment should be avoided entirely. In Chapter 8, we will develop an approach for calculating an appropriate margin of safety for growth stocks. When growth creates value. One of the advantages that stocks are thought to have in comparison with bonds, fixed income securities, is that they are a claim on a potentially growing stream of income. Within equity investing, the shares of a growth company, one with appealing future prospects, typically command a higher price relative to current earning, a higher price to earnings, P to E multiple, than those of a company that is not increasing its revenues or income. The reasoning is obvious. If the growth company can generate $1 per share in earnings this year, $1.20 next year, $1.44 in the year after that, and continue at that rate for some time into the future, the shares of that company are more attractive than those in a company producing a level stream of $1 per share in perpetuity. But this view ignores a key element of growth. It comes at a price. Growth in virtually every instance requires additional investment, and that investment must be paid for. For the example before, where earnings grow at 20% per year, let us assume that that growth needs 50 cents per share each year for added plant capacity and working capital. We will make a second assumption that the additional investment is funded by retained earnings. That means that each year, the company can distribute 50 cents less to shareholders than would be the case if it did not have to reinvest that money. So in the first year, of the $1 in earnings, shareholders get a dividend of 50 cents. The other 50 cents is retained and invested. The reinvestment continues each year, reducing the amount of earnings that can be distributed. By contrast, a non-growing company that earns $1 each year does not require new investment and can distribute the entire amount to shareholders. In this example, that $1 per year is more than the investors in the growth company receive until year 4. The crucial question for determining the net value of growth for a company is the relationship between the amount of investment needed to pay for the growth compared with the additional amounts and timing of distributions that the growth may produce. It should be intuitively clear that if the growth is slow enough and the investment requirements high enough, the current costs will not be offset by future gains, and the net value of the growth will be zero or even negative. Identifying a break-even growth rate that is high enough to create value for investors when compared to the additional investment required seems at first glance to be a complicated question, calling for intricate calculations. However, if this question is posed correctly, the answer is immediately apparent. The growth rate is not the main issue. In examining this relationship, the cleanest approach is to concentrate on cash investments required to support growth. Focusing on attention-grabbing growth rates and the high future earnings they may generate demands a complicated analysis that most growth investors shortchange. The allure of riches is one of the reasons investors tend to overpay for growth. A simple yet general example illustrates the point. Assume a company decides to spend $100 million to support its plans for growth. The investment might consist of new plants, new products, distribution facilities, and sales offices, all acquired for the express purpose of generating additional revenues and increasing earnings. Or it might be spent on acquisitions of new businesses or competitors in existing markets. A third possibility is that the money goes into the additional working capital, accounts receivables and inventory minus accounts payables, necessary to support growing demand in existing product lines and markets. Whatever the use, some investment is required to fund growth. No new investment means no growth. Growth that requires no supporting investment is extremely rare. The investors who provide the $100 million need to be compensated for the use of their funds. This point is obvious when the money is raised from outside investors. If it comes in the form of debt, the creditors will receive interest and ultimately the repayment of principal. If it comes from the sale of additional stock, then the new equity investors will be rewarded with their share of the earnings of the overall enterprise. But even when the funds come entirely from retained earnings, they still represent an additional investment. The existing shareholders are, in effect, providing the capital by accepting management's decision to make the investment to fund the anticipated growth. A decent management will take this fact into account in evaluating the investment and require a return at least equal to what those shareholders would demand if they were making the investments voluntarily. No matter the source, the cost of capital is the same. In each case, the return that must be offered to attract the funds voluntarily is the cost of capital associated with the $100 million investment in growth. That cost, in theory at least, depends on the level of risk inherent in the investment. For our simple example, we will assume that the required return is 10% and ignore for the moment the difference between debt and equity financing. Thus, the cost of attracting $100 million voluntarily from investors is $10 million per year. This cost is the downside of growth, and if it is high enough, it can turn growth from a profitable into a losing proposition. The upside is the future cash flows that the $100 million will produce. Again, to keep things simple, we will assume that this cash flow occurs as a constant percentage throughout the future and unlimited life of the investment. We will also assume that this rate varies across companies. As with all investments, some will have higher returns than others. Our cost of capital is 10%, and the annual cost of the $100 million investment is $10 million. For an investment that returns 5%, the $5 million of additional earnings is only half of the $10 million that must be paid to the investors who provided the $100 million in capital. Growth at this rate of return generates an annual loss of $5 million and destroys value for existing shareholders. If we value the annual $5 million loss at 10%, that produces a total loss in value of $50 million, or half the original $100 million investment. The company will have growing sales, assets, and operating income. If the $100 million comes predominantly from retained earnings, it will have increasing net income and earnings per share. Nevertheless, value has been unambiguously destroyed by the 5% return on investment. Next, consider a company that earns 10% on the $100 million and thus generates an additional $10 million in distributable cash flow. All of this money goes to the investors who provided the $100 million. There is no additional cash for the original owners of the firm. Despite the additional reported earnings, no value will be created and none will be destroyed. Unlike the first example, where growth was destructive, growth that increases returns by precisely the cost of the new investment is neutral and therefore irrelevant. It represents the boundary between growth that destroys value and growth that creates it, and helps us separate those investments that we do not want to consider from those we do. Our third example is a company for which the $100 million produces a still greater increase in sales and with higher profit margins. This project may return as much as 20% per year, which translates into $20 million in extra earnings. Paying the $10 million cost of the investment still leaves $10 million left for the original owners of the company. The growth produced by this project will create substantial total value for the existing shareholders or other stakeholders. Even after the new investors have been paid $10 million, there remains an additional $10 million per year in cash flow. If that is valued at the 10% cost of capital, this project creates $100 million in extra value on its $100 million investment in growth, meaning $100 million in added value. If $100 million can be invested every year with the same results, then the value of growth is prodigious and long-lasting, as the investment pays for itself and still leaves an additional $10 million for every $100 million invested. The key is the rate of return on the invested capital. High rates lead to value creation, just as low or negative rates, such as 5%, lead to value destruction. The answer to the question, is growth a good or bad thing for existing shareholders, is that it all depends on whether the return on the growth investment is less than, just equal to, or more than the cost of capital required. Our three simple examples provide the entire set of possibilities. What does not matter is the size of the investment or the specific cost of capital. The same consideration applies to an investment of $1,000 as to one of $1 billion. It applies to a cost of capital of 4%, 10%, or 15%. It is the cost of that capital when compared to the return the investment generates that counts. Which growth is this? How do we tell in advance whether the potential growth for this investment will equal, exceed, or even fall short of the cost of capital? Consider a firm that seeks to expand in markets or product lines where it has no sustainable competitive advantages and therefore benefits from no barriers to entry. In its projections, the firm may anticipate a return on investment that will exceed its cost of capital, say a 15% return on capital that costs 10%. But other companies will be scouting for similar opportunities, and they will locate this one, especially if the first firm's investments turn out to be highly and visibly profitable. With no barriers to entry, these followers will join the party, driving down the initially high returns of the first firm. These returns will continue to fall until all the attractive profit opportunities have been eliminated. Sooner or later, and generally sooner, every competitor will earn only its cost of capital at best. At that point, all the benefits of growth will vanish, and the brief phase of higher returns will have added precious little to the value of the company. More damaging still, this limited period will often be more than offset by a longer stretch in which overcapacity from all the new entrants will force returns down below the cost of capital. The lesson is clear. Without competitive advantages and barriers to entry protecting the returns of the initial firm, growth will create little or no value. Firms that seek to grow by entering a highly profitable market in which incumbents enjoy sustainable competitive advantages over potential entrants face even worse results. The high returns are a temptation. If the existing companies are flourishing, why not enter the market and enjoy a similar profitability? But the returns are high precisely because of the competitive advantages and barriers to entry that protect the incumbents from would-be entrants. A company trying to penetrate this market is on track to earn substandard returns or to fail in its attempt to establish a presence. A new, small, and aggressive entrant may be tolerated by larger and stronger incumbents, but its operations will be limited in scale. Since sustainable competitive advantages ultimately rest on economies of scale, it is difficult to see how the undersized firm can flourish. The likely result is that the entrant earns returns below its cost of capital. Any growth for a firm operating at a competitive disadvantage, or one with low quality management, is likely to destroy value. The only growth that creates value by producing a return above the cost of capital is in markets where the firm enjoys an actual competitive advantage or has the potential to create one, typically markets it can dominate in the future. A sustainable competitive advantage produces current high returns, and the barriers to entry protect the firm from having them eroded by would-be entrants in the future. The three levels of returns from growth we described in Table 6.3, below, equal to, or above the cost of capital, correspond respectively to the three instances of firms operating with regard to competitive advantage: those who operate at a competitive disadvantage, those competing on a level playing field, those who benefit from a competitive advantage. and these correspond to the three cases A, B, and C we identified in Chapter 3, in which earnings power falls below, equals, or exceeds the asset value of the enterprise. Thus, the Graham and Dodd approach to valuation, when coupled with a thorough grasp of competitive advantage, allows the investor to extend the analysis from existing operations to growth in the future and provides a direct and comprehensive answer to the question, when does growth create value? Understanding the competitive conditions that determine the value of growth provides insight into a host of growth-related issues. 1. The value of organic growth that is driven by increasing market demand, as distinguished from growth that is actively pursued by the firm. 2. The consequences of other favorable developments, such as new technologies that reduce costs and lead to growth in earnings, even if they do not directly increase demand. 3. The value of growth options, secondary opportunities that a company can pursue if warranted and avoid if unattractive. 4. The consequences of market shrinkage as opposed to expansion. 5. The differences between growth in core markets compared to growth in new markets. We will examine each of these issues in turn. Organic growth. The most desirable kind of growth for any company is revenue growth that arises organically from market conditions as opposed to growth in response to active investment initiatives. The investment involved is minimal. Additional capital consists chiefly of net working capital, largely additional inventory, and accounts receivable offset by growth in accounts payable and accrued liabilities. Fixed investments in incremental production capacity tend to be small relative to the average cost of capacity. When Walmart's revenue increases because more customers, due to local population growth, are spending more per capita, thanks to rising income levels, the incremental returns are usually higher than those produced by new store openings. This is especially true for markets in which growing demand results in higher prices. Consultants and books on business strategy invariably stress the benefits of operating in high-growth markets rather than those that are stagnant or growing slowly. However desirable and profitable, the benefits of organic growth and the value creation that ensues depend on the existence and sustainability of barriers to entry, meaning incumbent competitive advantages. Without these barriers, higher initial returns arising from organic growth will encourage existing firms to expand and draw new entrants into the market. The heightened competition will then drive down returns on invested capital for everyone. Entry and expansion will continue until returns no longer exceed the appropriate cost of capital for the market in question. They may persist even longer if there is an enthusiastic overreaction to the initial opportunities. The end result will not be value creation for the individual firm, but rather a greater number of companies in the market and more capital employed. Since this capital earns its cost, there will be no value creation in the long run, despite the initial high rates of returns from organic market growth. Only for firms in markets protected by barriers to entry will organic growth lead to sustained value creation. Favorable economic developments. In addition to high organic growth, there are other favorable economic developments that lead to higher returns. Two common examples are technologies that lower costs and innovations in marketing and distribution that increase operating efficiencies. Personal computers, tablets, and smartphones have all benefited from rapidly improving performance at declining costs. Again, the extent to which these developments create value for the firms that make them, rather than their customers, depends on the same factors that govern the value of organic growth: barriers to entry, sustainable competitive advantages. Without these barriers, the higher profitability that comes from lower costs, product improvements, and more efficient distribution will merely attract new entrants and additional capacity, both of which will intensify competition and drive down profitability. As in the case of organic growth, entry will slow down only when returns fall to the cost of capital appropriate for the market in question. All of these improvements will not lead to sustainable value creation for the existing firms unless there are effective barriers to entry that limit the impact of new competition. Growth options. Much has been written in finance about the value to firms of entering markets with extensive new potential opportunities that are created by unanticipated developments. The basic thesis is that firms that spot these opportunities can enhance their returns by responding aggressively to them. Conversely, they can minimize the impact of unfavorable developments by responding defensively. Again, as we should expect by now, in markets not protected by barriers to entry, the value of these growth options is severely limited by the increased competition that is sure to follow a successful innovator. Take the case of a smartphone manager who notices that certain combinations of features generate unusually high demand among particular consumers. For example, the ability to download and play music is strongly appealing to teenagers and young adults. The company adds that feature, raises the price of the phone to more than cover the additional cost, and sees sales rise rapidly among the targeted demographic groups, with profits growing in line. If the company had not originally anticipated this kind of response, the serendipitous profits earned represent a classic growth option. What happens next? We already know the answer. Without barriers to entry, competitors copy the innovating firm, add those features and perhaps a few additional ones, and market aggressively to the targeted groups. Competition, as always, drives down profitability, and new firms continue to arrive until returns have fallen below the cost of capital. This growth option then does not lead to sustainably higher earnings. If a new product feature fails, then the innovator eats the loss and competitors avoid the same mistake. In this case, too, the growth option has no long-run value. Also, a market with attractive profit potential and extensive growth options, unless they are unrecognized, will draw more competitors into the market in the first place, not a positive setting for high returns on investment. Without barriers to entry, this negative effect should on average offset the benefits of the potential growth options. Like other ostensibly favorable market factors, growth options generate significant economic value only in markets protected by barriers to entry. Shrinking markets. Markets shrink as well as grow. Creative destruction applies to markets as well as to firms. Tastes and technological changes induce consumers to spend their money on items that may not have existed 5 or 10 years ago. Where are the great turntable manufacturers of the 1960s? The Betamax tape format fell victim to a supposedly inferior VHS standard. Each is now a collector's item, as are the smaller tape recorders that replaced both of them. So markets do shrink and even disappear. Consumers do not have limitless amounts of money to spend and will shift their purchases from one place to another. The digitalization of so many things has eliminated a number of physical products and many of the firms that produce them. The consequences for firms operating in a shrinking market are in important ways the inverse of what occurs when markets are growing. It is the companies with competitive advantages in markets protected by barriers to entry that are hurt the most and experience the most value destruction. By contrast, firms in competitive markets with free entry suffer less from a decline in demand. Lower earnings in the future are offset by recoveries of capital, assuming firms are rational and willing to shrink or exit with dignity. Plants and equipment can be allowed to wear out or sold into other industries that might find them useful. Inventory can be reduced. If the capital recovered was previously earning around its costs, then the amount realized from the disposition and shrinkage of assets should roughly equal the value of the earnings that will no longer be generated by this investment. For example, if a company's earnings are reduced by $2 million, but it can recover $20 million from the surplus assets, it has essentially realized the same 10% return it was making before. Firms with competitive advantages are more hard hit by shrinking markets for two reasons. First, since they have been earning more than their cost of capital on investments, the capital recoveries from declines in demand are smaller relative to the income they had generated. The $20 million recovered may have been earning $4 million per year, for example. Its recovery does not fully offset the value of that $4 million in annual earnings. Second, sustainable competitive advantages are generally associated with economies of scale. Shrinkage leads to declining operating margins that are not compensated for by a reduction in capital employed. Fixed costs remain, and overall incremental declines are limited. When powerful monopolies with significant local economies of scale, such as local newspapers, see their market shrink, the magnitude of the value destruction is far larger than it is for local restaurants and other service businesses that had operated on a level playing field and were not protected by barriers to entry. Also, there is a better market for the restaurant's equipment and leases than the newspaper's presses, which may have to be sold for scrap. Expanding into new markets. A company with a competitive advantage in its core market may be tempted to expand into markets that are not a part of that core. The geography may be different, the product itself may be novel, it may even be crossing industry boundaries. For some reason, the management thinks that it can bring with it the competitive advantages it enjoys in its current locational and product markets. This decision almost always turns out to be a mistake. It is in the new market that the firm must achieve a competitive advantage for value to be created. No matter how strong its competitive position in its core market may be, if the firm has no competitive advantages in the new markets into which it expands, the growth involved will not create value. IBM and Eastman Kodak both entered the copier market in the 1970s. Each had what they considered technology that would allow them to compete successfully with Xerox, the market leader. But these choices did not work out as anticipated. Xerox had a competitive advantage, at least at that time, and even these two technology giants could not break in. When Walmart adds stores in its core markets, it does not need to increase advertising or recreate the distribution and management infrastructure already in place. It benefits from the barriers to entry erected by the regional economies of scale it already enjoys in these areas. Therefore, the stores, if they are properly located, should earn returns above the cost of the additional capital necessary to open and run them. The company can extend these advantages and profitability into adjacent markets that are within reach of its overhead infrastructure in advertising, distribution, and regional management. But the situation has been quite different when it has moved far afield and cannot rely on its existing infrastructure and captive customers. In these cases, it is often an established local firm that enjoys the benefit of a competitive advantage. Growth in these distant markets will almost surely destroy value, even before considering the difficulties of implementation and the need to overcome cultural differences. Walmart's actual experience of global expansion beyond adjacent markets in Mexico and Canada has confirmed this principle. For growth to create value in new markets, the firm has to benefit from competitive advantages within these markets. The advantages it enjoys at home are irrelevant. They may be harmful in producing overconfidence and the idea that the capital it will need to invest is somehow cheap, having been produced by retained earnings in the core business where the return on investment is high. As we have shown, this calculation is an illusion. Growth opportunities for value creation. Most of the situations we have described about the profit potential from growth strategies are cautionary tales. Profitable growth is hard to pull off in part because it sends a powerful signal to other firms that returns above the cost of capital are being earned by someone, and they think, why not me? Competition erodes superior returns, so the most positive opportunity for growth-related investments are those that are concentrated within core or adjacent markets where the firm's existing competitive advantages may allow it to prevent an onslaught of potential competitors and continue to earn returns above its cost of capital. In geographic terms, this involves filling in areas within core regions that a company already dominates and then expanding at the edges of those regions. This has been Walmart's strategy and that of other successful retail firms. It also describes the growth of Southwest Airlines, the most consistently profitable U.S. carrier. Southwest began with a single hub at Love Field in Dallas, focusing initially on flights only within Texas. It then extended its reach to adjacent states and secondary airports that it could dominate. Turning from geographic to product space, Microsoft serves as both a positive and a cautionary example. As it added essential office software, Excel, Word, PowerPoint, around its core operating system market, Microsoft was behaving much as Walmart did geographically. The result was a long period of consistent and large increases in profits and value. When Microsoft jumped into unrelated markets, such as game consoles, the results were far less successful. Walmart has done much less well in its ventures into Europe and Asia than it did extending from its home base in Arkansas. The second most positive growth opportunities come from entering markets where there are no existing dominant competitors who have both captive customers and economies of scale advantages. An outside firm with a focused strategy that it executes well may succeed in dominating these markets, as Walmart came to dominate Arkansas and the Mid-South in its early years, or Microsoft controlled operating systems for personal computers, aided of course by its adoption by IBM. These became the companies with competitive advantages, protected by barriers to entry, and they earned returns above the cost of capital that did lead to value creation. Though it all seems so inevitable looking back, it is important to remember that there were other firms in those markets, each of which had, at least at the start, the same opportunities as Walmart and Microsoft. Firms seeking to dominate these virgin markets must be extremely disciplined, focus on one market at a time, and superb at execution. Other than these two situations, the prospects for adding value through growth are at best limited and often negative. If the new market has no current barriers to entry, and given its size, structure, and other features, no likelihood that anyone will be able to create competitive advantages for itself, then the firm has at least the chance of doing well through superior management within a competitive environment. But if barriers to entry do exist, and other firms are already taking advantage of them, under no circumstances should the firm try to enter. This warning seems so obvious that it should hardly need stating, yet history has demonstrated repeatedly that the temptation to enter is strong and resisting it more difficult than it should be. The major firms in these markets are reporting high returns on invested capital, and many managers wonder why they too cannot rake in these profits and the rewards that accompany them. But these returns would not be sustainable without significant barriers to entry, so the newcomer is operating at a major disadvantage from the start. And should it somehow succeed in breaching the barriers and joining the inner circle of profitable firms, the implication is that those barriers are no longer intact, and other firms will follow, leading to the competition that takes its toll on profit margins and returns on investment. In a sense, the fact of a successful entry should lead not to celebration, but should raise the question, if they can do it, why not others? Markets with strong barriers to entry are like the classic Groucho Marx definition of a desirable club, one that would not admit him as a member. A last cautionary word on paying for growth. Any investor who pays up for growth by buying stocks selling for a high multiple of earnings or net assets in anticipation that future growth will create more than enough value to justify the price of the shares should remember what behavioral finance has learned about investing in these kinds of companies. First, they tend to be lottery ticket stocks with get-rich-quick potential at impossibly long odds. Therefore, as a group, they are systematically overvalued. Second, when investors or security analysts forecast growth rates, they extrapolate recent experience into the future. For high growth rates, as we noted earlier, this is an invitation to disappointment. Third, the estimates of value created by growth are extremely sensitive to the growth rates themselves. The value is great when the growth rates are high, but drops considerably as the growth rates decline. Even a small shortfall in rates has a major impact on value. Therefore, even after verifying that the anticipated growth will actually create value, that the market is protected by actual or potential barriers to entry from which this firm will benefit, value investors must proceed with caution when they invest in these companies. Growth in value there may be, but its ultimate size is difficult to ascertain. As we indicated at the start of this chapter, growth investing in franchises businesses has become an inescapable part of a value approach, but it must be practiced with extreme care. 7. Good businesses. 3 rules summarize our discussion thus far of the implications of growth for valuation. First, for firms with asset values above earnings power value, generally firms with poor managements or those operating at a competitive disadvantage, growth is destructive. It erodes value and is yet another reason for replacing current management as rapidly as possible. Second, for firms with competent managements in competitive markets, that is, firms with asset values roughly equal to earnings power values, growth is at best irrelevant and at worst a distraction. It neither creates nor